Welcome back, Mark is here. It's Monday, March 9th, 2026, which means I am literally one day away from NIO's Q4 2025 earnings call. And to break this all down, my analysis suggests something huge. I am really excited to talk about this one because honestly, what I am seeing in the options market right now is, well, it's highly unusual. Okay, that is super interesting. Let me break that down, starting with the actual numbers. I brought some research on the options market landscape specifically for this Friday's expiration, right? March 13th? Exactly. The March 13th options chain is the one expiring the exact same week as the earnings release, so it is the purest reflection of what traders think is going to happen right now. When I do an analysis of this specific chain, the open interest, which is just the number of outstanding active contracts, is heavily, and I mean heavily, concentrated in a very tight conservative range. Let me give the specifics. Where is all the money sitting right now? It is all bunched up near the current price. In my view, look at the critical call data. At the $5 strike price, I see a massive concentration with approximately 18,123 open contracts. Moving just a bit higher to the $5.50 strike, there is still strong interest, holding at around 12,538 open contracts. And at the $6 strike, it is still notable, but I can see the interest fading, with roughly 9,422 open contracts. Okay, so around 40,000 contracts just between $5 and $6. That seems like a decent amount of volume, does it not? It is, but here is the crucial part, and this is what really caught my eye. Once I look past that $6 mark, the open interest just vanishes. It drops off a cliff beyond the $7 level. The market is completely devoid of the rapidly rising premiums, the high volume, or the heavy positioning at those higher strikes, like $7 to $10, that I would typically see accompanying a highly anticipated earnings event. Wow, so literally nobody is betting on a massive home run here. It is like they have put a ceiling on their expectations. Precisely. And that leads me perfectly into what I call the low expectations trap. This highly concentrated data paints a crystal clear picture of market psychology right now. Wall Street expects NIO to do absolutely nothing, which is crazy for an EV company in this current market, right? But the data does not lie. The market is effectively betting that the stock will remain pinned in that $4 to $6 range following tomorrow's earnings call. The major players, the retail traders, the institutions, they are not speculating on a large upside move. It means the broader market is effectively asleep at the wheel regarding NIO's breakout potential. They have looked at the past few quarters, drawn a straight flat line and decided, yep, no surprises here. So if everyone is asleep at the wheel, why is this a bullish setup? If the smart money is betting it stays flat, should I not assume they are right? I would think so, but ironically, the most aggressive market rallies often occur exactly when expectations are at their absolute lowest. When everyone is positioned for a flat or slightly down market, the structure of the market itself becomes unbalanced. That brings me to the mechanics of the gamma squeeze. Ah, the famous gamma squeeze. I hear that term thrown around a lot on financial media and social platforms. Let me break down the mechanics of it in plain English. How does this low expectations trap actually fuel a squeeze? Absolutely. It is all about the market makers. These are the institutions that sell the options to the retail traders and funds. Their goal is not to bet on the stock going up or down. Their goal is to remain perfectly neutral and just collect the fees. So when they sell a call option, which is a bet the stock will go up, they have to go out and buy a certain amount of the underlying stock to hedge their risk. Okay, I follow this so far. They buy shares to cover the options they just sold. Right. But right now, because the market expects so little, a really unique structural advantage has formed. First, I see underpositioned traders. The masses are not holding upside calls, which means there is plenty of sideline capital just sitting in cash waiting. Second, and more importantly, my analysis suggests light hedging by the market makers. Because the perceived risk of a breakout above $6 or $7 is viewed as extremely low, the market makers have not bought many shares to hedge those higher strikes. They are lightly hedged to the upside. Oh, I see where this is going. If they have not bought the shares to cover those higher strikes, what happens if the stock actually does go up? That is exactly the squeeze trigger. Let us say NIO announces a positive surprise tomorrow morning. The stock starts to jump. Suddenly, all that sideline capital rushes in to buy call options because they realize they missed the boat. The stock pushes past $5.50, then $6, and the market makers start sweating. Exactly. The market makers are suddenly forced to rapidly buy shares on the open market to hedge the new risk from the surging stock price. As they buy millions of shares to hedge, it drives the stock price even higher. That higher price brings in more buyers, which forces the market makers to buy even more shares. It creates this rapid, aggressive feedback loop of upward price action. That is a gamma squeeze. And it is entirely made possible because they were underpositioned in the first place due to those low expectations. That is a brilliant breakdown. It is like a coiled spring. The tighter I compress it with low expectations, the harder it pops if the latch is released. But that latch has to be released by something real. I need an actual catalyst. So, looking at the fundamentals for tomorrow's Q4 earnings call, what are the specific catalysts that could catch Wall Street off guard and ignite this move? For this dormant options chain to spark, NIO simply needs to shift the narrative. Wall Street is looking backward. NIO needs to make them look forward. There are three key earnings catalysts I am watching very closely. First, and probably the biggest, is a surprise in their 2026 delivery guidance. Wall Street models are pretty conservative right now, are they not? Very conservative. In my opinion, if NIO comes out and provides forward-looking delivery numbers that noticeably outpace those conservative analyst models, the market will instantly reprice the stock. It shows that demand is accelerating faster than anyone modeled. Okay, so strong 2026 delivery guidance is catalyst number one. What is number two? The battery swap alliance expansion. This is NIO's unique moat. Nobody else does battery swapping at this scale. I need news of new partnerships with other automakers, or even better, clear plans on the monetization of their massive, unique battery infrastructure. If they can show that the swap network is transitioning from a capital expense to a revenue-generating asset, the street will love it. Yeah, changing that narrative from cash burn to cash cow would be massive. And that ties right into the third catalyst, I assume? Spot on. The third catalyst is profitability progress. Everyone knows EV startups burn cash, but the market wants to see the light at the end of the tunnel. I am looking for better than expected vehicle margins or an accelerated timeline toward true bottom-line profitability. If NIO's management team comes on the call and says, "We are reaching profitability 2 quarters earlier than previously guided due to cost optimizations," that alone could be the spark that forces a massive repricing. So, to pull this all together, I have a stock sitting in a completely dormant options market where everyone expects it to trade sideways. I see market makers who are unhedged for an upside move. And I have 3 very realistic catalysts: deliveries, battery swap monetization, and margin improvement that could easily surprise a sleepy Wall Street. That is the perfect summary. Historically, if I look back at the stock market over the decades, equities experience their most violent, positive upward moves exactly when the vast majority of the market is looking the other way. The options chain I just reviewed proves mathematically that Wall Street is entirely unpositioned for a strong earnings release tomorrow. It is almost a contrarian dream scenario. It really is. Now, obviously, NIO actually has to deliver the goods. If the earnings are terrible, the stock stays pinned or drops. But the asymmetric risk-to-reward ratio here is fascinating. If NIO delivers on these key fundamental metrics, the resulting scramble by institutions and market makers to buy shares could easily trigger the ultimate gamma squeeze. It is going to be an incredibly exciting open tomorrow. Well, this analysis has certainly given me a lot to think about. A classic trap for the bears, and a potential massive opportunity for those paying attention to the data. Thank you so much for tuning in to my breakdown of the options chain and the fundamental catalysts today. Let us see what tomorrow brings. I will be watching closely. For everyone listening, keep your eyes on those $6 and $7 strike levels tomorrow morning. I will see you next time.